Good morning, everybody. Happy post 4th of July Independence Day holiday. Today is Monday, July 7th, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macroeconomic and market commentary. You can follow me intra-week should there be something to say. We don't always do it. On LinkedIn, just Herb Morgan, or on X at Herb W. Morgan. The presentation you're seeing and are hearing is developed by me. It is designed to be used by you, whether you are an investor or a financial advisor. It doesn't matter. You are still expected to make your own investment decisions. Nothing contained in the presentation should be treated or thought of as investment advice, tax advice. There are no recommendations for purchasing or selling securities. Everything is for informational purposes only. And the views, when expressed, are mine. They are mine alone. They may differ from the views of CFIA's parents, affiliates, or other portfolio managers here at the firm. Let's get firmly into it. Another phenomenal week for equity prices. What a stock market rally this has been. I think everybody's happy about it, or we should be happy about it, right? Another 1 3/4% out of the S&P 500 last week. Mid and small cap stocks participated. International markets, I don't want to say took a break, but they've been on such a tear, as you can see, for the year. Bonds did just fine with a slight bid drop there on the aggregate bond index, but high yield still performing well. Finished, the first half of the year at 5%. Annualize that out, you get the idea. Not saying that will be the case, but just great numbers. And as the data starts to come in, we're seeing good data. As policy begins to be implemented, we're seeing market reaction to policy implementation. And for the most part, it's positive with some areas for concern. Let's get into the data we got last week. We'll start with the two manufacturing readings, S&P Global and ISM. The June S&P reading came in at 52.9. That was above the estimate of 52, and that's among the higher readings, really, of the last 3 years. So that's seen as a strong positive for U.S. manufacturing. But then, the next day, we get the ISM reading, which has been consistently below 50. It was higher, but still below 50. Came in at 49. It was a little better than the estimate. New orders fell, production rose, and employment fell as well. So what gives? Why is one reading of U.S. manufacturing, the other reading of the same thing, U.S. manufacturing, why are they giving us two different stories? And which one's right? Well, let's take a look at the difference. S&P Global versus ISM. First off, S&P surveys about 800 firms, while ISM is a smaller survey, usually around 400 or 500, but they say between 300 and 800. S&P more heavily weights the forward-looking components, specifically new orders and output. So the S&P survey, even though it's a survey for the month of June, is more of a sentiment survey of where the respondents think the economy is going. And the ISM actually just equal weights all the components to the survey, giving it is forward-looking as well, but it's more heavily weighted towards the reality of today. S&P is U.S. manufacturing and manufacturers only. ISM includes the large multinationals that are in the midst of a level of uncertainty around supply chain responses to the global tariff implementation, the trade wars, if you will, that are happening, and the related cost pressures that will find their way through there. So I think that explains the difference for the last couple of months, because there's always differences, but it's just been more pronounced lately. So I wanted to give that to you so you were aware of it and understood it. Then we have S&P services and ISM services, same thing here. June fell to 52.9, still a great number. Remember, services is a far bigger part of the U.S. economy than is manufacturing. ISM, again, same differences. We had this issue related to uncertainty around trade and tariffs. So if you think that those are being more favorably resolved, then you would expect the ISM numbers to catch up with the S&P numbers, and you might rely a little more heavily on the S&P numbers, just given this situation today. Not permanently, but just given the situation we find ourselves in today. ISM services came in at 50.8. So it is, again, higher, but not as positive as the S&P, which more focuses on domestic-only firms. The one area that still is pretty horrible is construction spending, specifically residential construction. Fell another 0.3, more than expected. It's been flat or negative in 11 of the last 12 readings. We know why. This is rate related. This is an industry that focuses very much on borrowing costs and demand. Residential real estate, we've talked about it every week almost, is in the tank, waiting for those rate cuts, which could come as soon as July. I might have jumped the gun a little bit with that prediction, but I still think there's a chance. And I know we're well into July now. It's a small chance. I think for sure we get at least 25 bips by the September 17th Fed meeting. We got auto sales for the month of June, annualized rate there 15.3 million, right in line with expectations. Not a great number. Still, we had the 2 big months trying to get ahead of tariffs. Now we've got the 2 months post-tariffs to smooth it all out. Not a lot to see here. Weekly claims for unemployment came in, as did JOLTS, as did ADP employment, as did BLS employment. So last week, to a certain degree, is all about what's the jobs market looking like, whereas next week is going to be about the beginning of earnings season. On a weekly basis, boom, great, that number is coming right back down and bringing the 4-week moving average with it. Weekly claims fell to 233, continuing claims unchanged, 1964. That was seen as a pretty good bit of news for the labor market. Job openings rising, good bit of news again for the labor market. We had been on this decline, this post-COVID decline. We seem to be leveling out now. 7.8, call it 7.8 million job openings. That was above the expectations. Then we got the 2 national employment reports for the month of June, starting with ADP, Automatic Data Processing. They handle most payrolls, right? Not most, but a good portion of U.S. payrolls. So their survey is based on their data of actual companies hiring. They say jobs fell by 33,000. The estimate was for an increase of 98, so it was not a good number. And the month before, which was May, it was only 29,000. So that's 2 very soft numbers from ADP. However, a competitor report from the Bureau of Labor Statistics says, no, things were pretty good. Non-farm payrolls added 147,000. The estimate was only 106. Unemployment rate actually fell, but unfortunately it fell because the labor market, the participation rate in the labor market shrank a little bit. So we wouldn't sort of pat ourselves on the back too much about that, although you always welcome a lower unemployment rate. So just like we looked at between S&P and ISM, what are some of the differences between ADP and BLS? Why does ADP look soft while BLS looks good? First off, ADP only measures private sector payrolls, about 25 million of the 160 million workers we have, so they have a big percentage of the market. The BLS, however, includes public sector, meaning government workers, and it is a bigger sample size, about 131,000 establishments or job sites, including state and local hiring, which is notably strong every June. ADP tends to be a little more volatile. Little typo there, take the S off. BLS includes seasonal adjustments, try to smooth the data out. So they want to have smooth adjustments to the data, or ADP just says we're going to give you the data as it comes in. Why did they split in June? The Bureau of Labor Statistics report showed about 73,000 government jobs wouldn't make it to the ADP survey. So the conclusion we can all make, and it's the conclusion the Fed will make because they see the same data we do, is that private sector hiring has slowed. that is part of the reason why there are people who are advocating, saying, hey, we know the inflation data is about to get better in the fall, which you and I talked about last week, and we see the labor market hiring softening. It's time to cut rates. And I think there's political considerations, but the Fed is not just waiting for the PCE number to get to 2%. They see the trajectory, they have models, they have estimates. This is why I still think that July 30th, I know I got asked on a conference call this morning from our colleagues in Ireland if I stood by that comment. My conviction level has come down a little bit, to be honest. But I still think there's at least a 50% possibility. The market's saying it's about 15. So stay tuned. We still might get something in July, maybe on that July 30th meeting, maybe 25 bips, or at least language that says we're ready, which puts the cut almost, which makes it certain the cut comes in September. Market reaction would be positive to either a cut or indications the cut is coming. Okay, moving on to our trade deficit, a huge gain from a couple of months ago, not as good as the month prior, but May's trade deficit went to 71.5 billion. You can see if we get down in that 60 level and stay there, or really get to the 40 level, we've made progress. Trade deficit cuts GDP. Trade surplus would add to GDP, or a shrinking of the deficit would add to GDP. We had the big surge in imports, people getting ahead of the tariffs. That is now behind us. The question is, where do we go with this deficit now that several trade deals have been cut? Obviously, more to come. Factory orders surged 8%, but big ticket transportation items backed those out. It was just 0.2%. Not a big deal. Reverses the prior month big decline that you can see over on the right-hand side over here on this graph. So what is driving this U.S. equity rally? We've had a heck of a rally off the bottom from the correction. If you remember late last year, early this year, I kept saying 15 to 20, 15 to 20. We got it. The economy stayed strong. The economy stayed good. Now we've got pro-growth legislation. It was passed last week, now and signed by the President of the United States, a pro-growth tax policy as known as the One Big Beautiful Bill. Very stimulative. Parts of that encourage investment, which encourages GDP, which encourages profits, 100% expensing of capital investment, small business, large business. That will drive economic activity just like it did in the Tax Cut and Jobs Act of 2017. The permanent U.S. corporate tax rate, highly competitive 15% rate in there. It's going to boost after-tax earnings and cash flow. Lots of regulatory rollback. It's very costly to meet regulations. That would help with profitability, drive domestic production, innovation, and most importantly, investment. I showed you a couple weeks ago, we're at over $2 trillion announced investment in the United States. Other things happening outside the One Big Beautiful Bill is AI is taking off. We're all using ChatGPT now in our personal lives, but AI is going to drive efficiency. It's going to drive profit margins. Mega cap techs are on a big rally. There's also commercialization breakthroughs that will filter through to all industries, leading to broad productivity improvements. This is also disinflationary. That's helpful. I mentioned that inflation expectations are on the decline. There were some high numbers in the fall, starting August, September, October, November of last year in CPI, PPI, and PCE. Those numbers will all roll off and be replaced in the one-year calculation with the numbers we're about to get, leading to big drops in the year-over-year numbers, giving the Fed the all clear to cut. I think they could do it in July. They might wait till September. Overall, not that important. Then we got yet another announcement over the weekend. The president really wants to drive the inflation down, and they think that the path to doing that is energy. Another increase in output from OPEC. So there was some behind the scenes going on there, I am sure. And from a fiscal perspective, $28 billion came in tariff revenue. That's up from $20 billion in May, and sort of in the last year we'd average around $7 billion. So the numbers are real, they're consequential, they will help with deficits, but to be sure, the one big beautiful bill with CBO scoring as it's supposed to be done shows bigger deficits. I think the administration is expecting those deficits to not materialize. Their rationale is that the CBOE does not account for higher rates of growth, therefore higher tax revenue from the higher growth, number one. And number two, it simply can't account for what's expected to come next from the House of Representatives, which are rescission bills. At least one or two rescission bills. They went home for the 4th of July holiday. They're going back, and when they go back, Speaker Johnson has assured people that they now plan to offer rescission bills. What is a rescission bill? Well, remember, the law in the United States is if Congress allocates money, it must be spent. The administration, the department heads, the president, nobody has the authority to save money, so to speak, or to spend less. They can try to improve processes, but they must spend all the money that's been appropriated by Congress. It's part of our separations clause. But now the speaker can go back and say, hey, there was a lot of money allocated for different things that hasn't been spent. Let's rescind that, particularly things like COVID relief funds. We're well beyond the COVID pandemic now. That will come back to the Treasury, out from the agencies. That will help as well with the projected deficits. That's what they're counting on. Is it risky? Yes. Is it guaranteed to happen? Absolutely not. Is it appropriate to discuss it? Yes, it is. That's what's happening in the financial world and politics right now. Not much in the way of data this week. Small business optimism, consumer credit, Fed minutes, important, jobless claims, and the budget. We're looking at a $37 billion deficit in June. It would be really great if we saw some bigger improvement there. That could help markets rally, because of tariff revenue or some other things. $37 billion is getting closer to a balance. Now, admittedly, June is a big revenue month, right? A lot of people pay estimated taxes in June, so it really should be a big surplus. And comparing it to that $316 billion deficit in May doesn't make sense, but that's how the data comes out. Two companies report earnings this week, Delta Airlines, Fastenal. Good, important, but not that important. We really start with corporate earnings next week. We always start with the big financials. They have all passed their stress tests with the Fed. Therefore, it is likely, in my opinion, that they will announce stock buybacks and dividend increases next week, giving further fuel to the fire of the market. I didn't show you any graphs of the markets today, but we're back to being quite expensive. The S&P is at 22 times forward. The relative strength index in the S&P last week got above 75. That's usually a sign to take your foot off the gas, to tap the brakes. Do not think we're getting into a 10 or 15 or 20% correction at all. If you were a trader, some folks wrote some calls, including yours truly last week, just because it ran up a little too much, too fast. Thanks, everybody. I'll see you again in 1 week.